Mark Fleming is a chief economist from First American Financial. He leads an economic team responsible for analysis, commentary, and forecasting trends in real estate and mortgage markets. And this guy, if you've ever read anything that he's written or if you've heard him speak, he's a brilliant man, and we are thrilled to have him to the stage this morning. So let's give him a big round of applause and bring up Mark this morning. Thank you. Appreciate it.
All right. So usually after those kinds of introductions, I like to finish it off by saying I like long walks sitting on the beach, romantic dinners by candlelight. Right. I'm an economist, and that means you're all like, oh God, the next hour is going to be really boring, right? And scary. But I think we will start by really focusing not so much on the housing market or the traditional economic data, but sort of question what we really know and understand about our market today. In particular, given the events of the election, we're all concerned about what the future means. Certainly in every industry, I can't get enough. You know, when I look at my Twitter feed, there's so much content still related to effectively politics at the moment, and our big sort of risk or understanding. And so in that context, I think it's important to really try and break down and understand what's sort of really going on in our economy today. So we'll start with a simple polling question. How fast do you think the US economy should be growing? Throw out a number. Throw out a number. How fast do you think the GDP growth rate for the US economy? He's saying 3 over here. Anyone for higher than 3? 3, 3.5, 3.5, 4? Anyone for higher than 4? 4.5. Do I see 4.5? Do I see? No? Come on. No one person for 4.5 over there. Are we going for 5? Anyone thinking we're like China? No? Okay. Anyone on the downside, below 3? Who's a pessimist in the room? Did I hear 1.5? Okay. Man, you must have had a bad night at the tables last night, right? I made some back last night, but I'm still in a hole. Okay, anyone for below 1.5? Real pessimists. So we're ranging from 1.5 to 5. This will be really quite interesting. Are my slides ready to go yet? No? Okay. We'll wing it then. What drives GDP growth? So what is GDP to begin with? Gross domestic product, that's what economists call it, but in English terms. What's GDP? Yeah, throw it out there.
It's movement of goods and services between parties.
So exchange of things? Yeah. Stuff, that's a technical economics term, by the way, stuff. Dollar value of stuff created in the economy, right? So somebody trades something, it's done at a price, and we measure the dollar value of all of that transactional activity, or all that stuff that is made, right? How do you make stuff? How do you make stuff? Okay, how do you manufacture stuff? With other stuff. How do you get that stuff?
It's 9 o'clock in the morning.
I'm putting you on the spot here. This is really simple. Don't do economics, just do plain and simple. What do you need? You need to buy it. What do you need to buy it? That's what we call capital in our land. We're good? Okay, good. That's what we call capital, right? What else do you need? When you take a piece of capital, like a computer, is a computer any good unless you put something with it? Well, no. What do you sit in front of the computer? People. Thank you. Gosh, that was tough. People. People, capital, and one other thing. One other thing. Where? Where does that person in that computer sit? In an office. So land. 3 factors of production: land, labor, and capital. Okay? Little economic history lesson. Medieval England. Of those 3 factors of production, which were the 2 most important? Land, labor, and capital. Which were the 2 most important? Land and labor. Not a lot of capital being deployed in medieval England, right? And who earned all the profit? We call it rents in economics. Who earned all the rents? The owners of land, right? As opposed to the peasant. In those days, medieval England was growing at effectively their estimated GDP growth rate was 0.2% per year, right? In fact, most of medieval history up until the first industrial revolution, economies grew at 0.2% a year. That means it would take 350 years to double the size of the economy, okay? Put that in context today, at a 2% growth rate, just to make the math easy, 2% growth rate doubles the economy every 35. Take the 0 off, 2 versus 0.2. 35 years. Every 35 years, right? At a 2% growth rate. So fast forward to the first industrial revolution. Land, labor, and capital. Which factor of production becomes a little bit more important in the industrial revolution? 1779 to 1810. Sorry? Land? No, which is more important now? When we create an industrial revolution, we start making things. No? Land, okay, finally, there's only one left, right? Capital becomes more important. You need capital to build the new manufacturing plant, to build the looms, things like that. Okay, so at the time of 1776, do you know what a hand loom weaver is? Right? Do they exist today? Not very many, right? Not very many. At the time in London, hand loom weavers in 1776 was a pretty thriving textile industry. They did a lot of hand loom weaving. Somebody invented an automatic stocking maker. Now, think in those days, stockings were worn by men and women, right? Invented a stocking maker. And the hand loom weavers didn't like this because it was going to put them out of a job. So they rioted. And this guy named Ludd was apparently accused of burning down 3 stocking making machines. John Luddite, or John Ludd, from which the term Luddite comes, right? And a Luddite is someone who resists change, particularly technological change. We use the term right now, I'm a Luddite. I have no idea what to do with my iPhone, right? Resistance of technological change. It so turned out that those handloom weavers found new jobs in other industries because the Industrial Revolution, while it destroyed certain industries, it created new ones, right? Turn of the 20th century in Boston, right? Most people in Boston, but most major cities across the industrialized world in the turn of the 20th century got around how? How did we get around in 1900? Horse and buggy, carriages, right? In fact, the vast majority of people didn't own their own transportation, right? It was too expensive. How would you be able to afford not only the horse, but the carriage, but all the equipment to go with it, and to feed the horse and stable the horse? There was a huge industry associated with basically transportation of people and stuff at the turn of the century that was all horse-driven. By 1940, what did practically every American household have? Did they need a horse anymore? So the complete destruction of a large industry. In fact, we'll get a little nasty here for a second. Do you guys know how much a horse creates in a day and leaves behind? 50 pounds. Do you know how many horses were in 1 square mile of Boston at the turn of the 20th century? 700. Do the math. There were actually people whose job was to go around cleaning up after them. All gone, right? But those folks got new jobs in new industries, right? Name a new industry that came out at the turn of the century.
Yes.
Making cars, right? Things like that. So the question that we're really focused on today with this concept of automation angst, we've seen this before. We've seen angst in many industries with the fact that automation or technological change or some sort of industrial revolution, we're basically going through an information revolution today, it somehow changes our lives and we fear that we cannot find a new job or cannot find a new way to do things. But what we don't know, we can't know for sure, is what new industries will be created out of this technological change. The question simply becomes today, do we believe that there will be new things that those who are being displaced out of jobs today will be able to do? What do you think? You're a believer. You're a believer. Anybody else a believer? All right, yeah. So the eternal optimists, the 2 of you in the room, right? Your eternal optimists would say, yeah, we're going to be okay. We'll find new things to do. Let's put this in context. These are all of the recessions since World War II, measured by the amount of decline on the y-axis. So the further down you go, the deeper the recession was, and the amount of time it takes for recovery. One thing to note here is the 3 most recent recessions, or the biggest one here, the 2007 one, it felt bad because it was. It was the deepest recession since the Great Depression, and it's taken us the longest time to recover from it. And part of that is not just because of the fact that it was a big recession, is that it happened to happen at a time when we're going through significant changes in terms of automation, right? We're going through also significant changes in terms of demographics. We'll talk about that in a minute. Okay, how do we make stuff? You can apply labor. The more people you put to work, given your capital and land allocation, the more output you can create. And you can see through the 1950s, we had a blue line is the growth in the labor force, green line is your GDP. You can see that as we grew the labor force faster, we got more GDP growth. We were ticking along green, smooth line is the smoothed out of that crazy green line, was even about 4 to 5% at points in time. So we were growing quickly, but that was partly because we were expanding the labor force relatively quickly. Who was it that was going to work? 1950s and 60s. Women were entering the workforce in 70s and 80s. And since then, it's slowed down because some group has not entered the labor force as fast as one might have hoped. What group is that? Yeah, those pesky millennials. There's a few of you in the room, so I have to be careful about what I say today. Okay, so you can expand the labor force. Now look, most recently, that blue line is just beginning to tick up again, right? That's the large entrance of millennials beginning to influence things. Millennials are the largest single generation, bigger than the baby boomers. And in fact, right now, they already represent the majority of the workforce are now millennials.
That's scary.
Depends on your perspective, right? Yes. Okay, productivity. So you can take the amount of labor that you have in the workforce and you can make each unit of labor, each worker, more productive, right? That would expand the amount of stuff that you can create. The pesky problem with productivity, certainly from an economist's perspective, is we have a really hard time understanding how and why it comes about, right? We know that we saw in the 1940s and 50s with sort of the manufacturing heyday of America that we were applying a lot of capital in the form of machinery, right, to those workers, and those workers were being made incrementally much more productive. We had very high productivity growth rates. That helps us to grow the economy faster because not only were we expanding the labor force, we were making each unit of that labor force that much more capable of producing more stuff, right? The question becomes today, look at that blue line, which is the smoothed out productivity growth rate trend, has actually gone negative. Why are we not able to create more productive output per person today? I mean, we have all of this amazing technology, right? You know, sorry? That's part of it. In fact, one of the reasons why we did grow so quickly and expanded our labor force and had that high productivity, if you think about the 1940s and 50s, is we had no world competition. World War II had just happened. The only other part of the world that there was a significant amount of manufacturing base was in Europe, and that was all bombed to all get out, right? It doesn't exist. They were so busy trying to reconstruct themselves that basically American manufacturing was the grand exporter to the world in the 1940s and 50s. City in the United States in 1950 with the highest median household income. Any ideas? Yep, Detroit. My, how things have changed, right? Detroit was the highest median household income. Now that labor was actually capturing a share of the rents or profits from the owners of capital, because capital was relatively intensive in manufacturing a car. You had to put up a lot of capital to build the manufacturing plant, the manufacturing line. You put your relatively effective, productive labor force to work. But technically speaking, the owners of that capital should be the ones getting all the profits, right? Except for one thing. In the 1950s in the auto industry, what did you have? What did labor have? Unions. And unions had the ability to basically say, share that profit more equitably with us, please, right? So what's happened since then to unions? Unions have weakened, generally speaking, right? What's happened to the importance of capital as a factor of production in today's modern service-based U.S. economy? More or less important than it was at the turn of the century in 1950? It's more. Capital is the king factor of production today. You, in fact, don't need that much labor. Think of like Uber or Google, right? You don't need that much labor. You don't need that much land, right? Office space. But you do need a fair amount of capital. And even today, that's even being broken down with things like the internet and Uber. The challenge then becomes, so capital is the owner of the largest, most important factor of production. Capital accrues all the profit, right? Think of some rich people in the United States today. Throw them out there. Rich people in the U.S. today. Sorry? You said who? Buffett. Buffett. Finance. That's capital, to be pure. Who owns Facebook? Google. Microsoft. These are the new Rockefellers and Vanderbilts and Mellons of the American economy, right? And how did they do it? Technology, right? These are the owners of the factors of. Now, how do you compete as an individual? If you're not Mark Zuckerberg, how do you make sure that you're successful in this modern economy? What do you need to be able to compete as a worker? Think about who works for Google. Skills. Significant particular types of skills, right? Right? What do you need? What do you usually need to do to get those skills? Education. Education. In fact, one of the things that happened with the New Deal after the end of the Great Depression was we mandated that everybody in the United States has the right to a free education through 12th grade, right? And what did we see in terms of the productivity of the labor force in the 50s and 60s after that? Some of the highest productivity growth that we've ever seen, because at the time we had a very highly trained, skilled, educated workforce for that economy. So the question becomes, do we get better productivity growth in the new economy if we make some changes? This is more about the sharing of that wealth concept, right? The green line is real GDP, so we're taking out sort of the inflation rate, and it's real GDP per capita. So we're also accounting for the growing size of the population in the US. This is a rough, crude way of measuring our well-being, right? Presumably, the more stuff per person that there is out there, the better off we are, right? Well, one might argue that leisure time is important, but in general, measured from an economist's perspective, green line measures the relative increase in our well-being, right? You can see that we've almost doubled the economy in terms of size. It's up to 180. 200 would be a doubling since 1979. Blue line is real full-time employed median earnings. Wages, right? Wages. Flat. So we've doubled the amount of stuff, but the real income has not changed. This is sort of fundamentally what's happening underneath the hood of all the gyrations in economic recession and things like that in our economy today as we switch to a more and more capital-intensive output. Another way of looking at it, splitting those who earn low earnings versus high earnings, we roughly cut it at $40,000. It makes the math easy. So high earning jobs are jobs created for above $40,000 a year salaries. And you can see we've created 20% more since the beginning of this century in terms of high earning jobs, and we've actually lost about 20% of low earning jobs. And it gets even scary if you start looking down in the tranches further down. In fact, we're doing a pretty good job of creating jobs like baristas, waiters, really low end, right? Minimum wage type jobs. We're doing a really poor job of that middle income, sort of 30 to 40, sort of working class job, because that's the one that's being typically replaced by that automation. To make ourselves cry more in our tea and head back out to the blackjack tables, you know, do you want to be a robot maker or a wage taker, right? Those high-earning jobs are earning more. We're creating more of them, and the growth in their earnings is increasing, right? There's no question that a highly trained computer programmer is going to be able to find a very good, well-paying job in our economy today, right? In fact, there's a lot of competition for them. The question becomes, how do you become them? This is one of, I think, most interesting and scary charts in my mind. Who here likes Scotch? Oh, good show of hands, right? I love Scotch. I went to Scotland on a Scotch tasting tour, and I went to one of the largest distilleries there to do the tour, and they walked us around the factory. There's not a human in sight. Steel everywhere. Beautiful. Computer consoles next to the mash tun that could produce huge amounts of the wort and clean itself, by the way. Clean itself. The whole process to distill gallons and gallons and gallons of Scotch run by 2 engineers at a time, working 8-hour shifts. So 6 guys running this distillery 24/7 with 2 backups. 8 civil engineers, effectively, right? Sitting at computer consoles, making the most Scotch in Scotland, exporting it here. Glenlivet is the brand, right? And they were very impressed by this, and it was impressive. But I raised my hand and I asked the question. So we have 8 highly trained individuals running one of the largest distilleries in Scotland. How many people worked here before automation? 130 a shift. Down to 6 with 2 backups, right? Because of that technological change. Orange line is the employment index measured on the right-hand side. So the number of people employed in manufacturing in the United States since 1980. Blue line is the amount of output in manufacturing over that same period of time. We are generating more output in manufacturing than ever before without the people. I got news for you guys. We can bring the industries back, but it doesn't bring the jobs back, right? We don't manufacture textiles with hand loom weavers anymore. We do it with computers and technology and the application of capital, right? We're very successful. Do you know how many people actually work in manufacturing in the US economy today as a percentage of the workforce? 2. Pre-Civil War, it was 90% worked in either farming, mostly farming, and manufacturing. Only 10% worked in services. Now, in our modern economy, 90% of us work in the service sector and only 10 in manufacturing and agriculture. Complete change over about 150 to 160 years. Okay, let's go here. Actually, yeah. So this is household income since 1984. Blue line is the nominal uninflation adjusted household income. Typical household in 1984 was earning about $22,000 a year, median. Now they earn about $55,000. Orange line is when you take inflation out. Orange line, median household income, is what everyone is referring to when we talk about stagnant wages, stagnant incomes, right? Because it's really only bounced around between, say, 50 to 56 at its height, and has subsequently come down. So stagnant median household income. That's an important factor that sort of highlights all the stuff we just talked about. So what does that mean for the future? Blue line is the headline unemployment rate. Peaked at about 10%, now just slightly below 5%. Orange line is what we call the natural rate of unemployment. This is our estimate of the level of unemployment that should exist in a healthy labor market in the US economy. There's always people turning over through jobs. When you go below that natural rate, if we're right, when you go below that natural rate, you start to get a lot of inflationary pressure. So we're right around that mark right now. When you obviously go above, that's a recession. You don't get a lot of inflationary pressure. The one thing that's holding things back, in particular, Janet Yellen and the Fed's focusing a lot on, there's a lot of talk about, is the fact that there's underemployment or labor slack still in the economy. Well, the headline unemployment rate says, no, we're good. But the slack comment comes from the light blue line, which is those that are, let's see if I can get this right, marginally attached or part-time or marginally attached to the labor force. That's the PhD economist who's working as a barista at Starbucks, right? That's the person who has manufacturing technological skills but is a waiter or a server somewhere instead. They would like to work more or work in higher paying jobs, but they can't find them. And that blue line, it's a little bit hard to tell here, but that blue line has actually not come down proportionally the same rate as the overall headline unemployment rate. So we do have a few million extra people than normal who are underemployed in our economy today. And that's one of the reasons why it's hard to see wages growing. Okay? We'll talk about the labor force participation rate in the demographics section, actually. Okay, let's go here. I love this quote. It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. What do we know for sure about millennials? If there are any of you in the room, I apologize in advance. They know everything. They like technology. Where do they live? Oh, they all live at home still, right? Right? But here's the thing, right? I mean, look, the average size of the typical American house has almost doubled in 40 years, right? So I get my own bedroom. Mom's a better cook than me. Why do I have to pay all that expensive rent, right? Right? I can borrow a car to get into town if I need it. So yeah, they all work. They all stay at home. About a third of all millennials right now, according to a Pew Research study, still live at home with their parents. But that means 2/3 of them are not. And 2/3 of a really big-sized group of people makes a big difference, right? What else? What else do millennials? We're absolutely certain millennials will never want to do this. Buy a home, right? We'll never want to buy a home. Really? Are we sure about that? No, let's see. Good answer. Okay, home ownership rate in the United States, pretty much spent 30 or 40 years ticking around between 63 to 64.5 or 65%. And then all of a sudden in 1994 or so, it started to go north. What happened? Well, there's the demographics aspect, but more particularly in 1984, we started to push this thing, right? Housing policy geared heavily towards the concept of home ownership. We had the advent of a technological change in the residential real estate marketplace. Technological change, 1994, desktop underwriter. Soon to be followed by loan prospector, right? Automated underwriting. Created much faster, standardized, efficient underwriting of mortgage loans, right? We were able to push that envelope. Now, demographics, someone mentioned, yep, baby boomers were aging even further up that age curve for home ownership. That certainly helped to drive it. Peaked at 69% in 2005. I'll argue that probably the last 2% were due to, shall we say, financial innovation. Yeah, I like that term. So, 69% then comes crashing down. We are now at half-century lows in the home ownership rate. Okay, folks, let's take a step back. Take a look at that axis. It ranges 8 percentage points. Only 8 percentage points on that left-hand axis. In fact, if I expanded that axis, you wouldn't even be able to see the variation in the home ownership rate. So yes, while it's at 50-year lows, some have said it's the advent of a renter generation. We're all giving up on home ownership. Well, I'm looking at the math, still more than half. Almost 2/3 of us are homeowners still in the US. So that ain't so bad, right? And in fact, only about half of that decline in the home ownership rate was really due to the economics. Of course, when we foreclosed on about 4 to 5 million people, we turn a homeowner into a renter, hopefully, and not a homeless person, right? They must become a renter somewhere, so that drives down the home ownership rate. One other important thing is, let's go here. Green line with the orange smoother curve so you can sort of see through all that volatility. Green line is the growth rate in rental household formation. Blue line is the growth rate in owned household formation. So how all those households are changing and the mix of them. And you can see prior to the Great Recession, we were typically generating many more new owned households than rented households. And then there was sort of a big shift. Since the end of the Great Recession, we have generated 6.4 million new rental households. We've lost 1 million owned. Home ownership rate math, folks. Number of owned households over the total. We are fast increasing the total base of households with renters right now. Who are all those renters? What do you do when you finish college and you decide to move out of your parents' parents' house? You rent with your buddies, right? You rent a house with your buddies. So all this rental household formation is largely driven by millennials aging into exactly what every other generation has done before them. Maybe the timing's different. Maybe they spend a little more time at home first. We've seen a huge amount of rental household formation. Who here works with multifamily builders? Why are we building so much multifamily stuff right now? It's booming to serve this demand. Have we seen this before? Yeah. When baby boomers were in their early 20s, we had a huge boom in multifamily demand that then ultimately switched to single-family owned demand, right? That's when we went and built the suburbs. Right now, we're going through the response to the demographics of a very large cohort in the form of millennials coming out and renting at a much faster pace than owning. The question becomes, well, okay, if they're renters, what kind of rentings do they like to do? Where do they like to rent? What kind of amenities do they like? They like to live in the city. What does the city provide? Walkability, public transport, so you don't need to own a car. What do they like to, well, yeah, jobs usually, but what do they like to do in the city? Leisure activities include doing what? Restaurants, bars, coffee shops. I asked this question in a presentation before and somebody yelled out, girls. I kind of get that one, okay, sure, yeah. Right? So that's the amenity package there. The question then becomes, that's what they'll always want, right? Are we sure about that? Let's go here. So we're going to compare millennials to Generation X to baby boomers, and baby boomers are our reference, each when they're age 30. Because there's big differences between when you're 25 and 30 and 35 and 40, right? Big differences in what you're interested in. So baby boomers at age 30, that's your blue reference line in each one of those dimensions. For example, the home ownership rate. 30-year-old baby boomers had a home ownership rate of about 55%, right? And then we compare each generation when they're age 30 and say how much better or worse in proportional terms are you doing. You guys with me there? Home ownership rate, you can see Generation X did about the same. We've already established millennials are behind baby boomers in terms of age 30. The question becomes why? Is it because of a lack of income or a lack of access to jobs? Sure, Generation X did better at age 30 than baby boomers did, and unfortunately 30-year-old millennials are coming out after the greatest recession since the Great Depression. That makes things a little more challenging, but they've done as well as baby boomers. Oh, but we do see one real striking difference, right? And that is that they're getting educated. In fact, getting educated at a faster pace than any other prior generation before them. And that's a secular trend in response to what we talked about in the economy and the further capitalization and importance of skills in our modern economy today. What does education take? What do you need to get educated? What is it? Two things education takes. Time and money. Time and money, right? And if you're busy getting educated, you're not doing what? Babies. Not getting married and having babies, right? So there's two economic models of what we call tenure choice, whether you want to be a homeowner or a renter. Model one goes something like this. Well, I need to compare the net present value of the conversion of the cost of the home into an implicit rental stream to compare to my rent. I got to take into account the mortgage interest deduction. And what is my discount factor? Not even economists think like that. Model number two, my wife told me to, right, is that the lifestyle decisions of getting married, particularly, and then having children, tend to be the most important decisions for drivers of whether or not you want to be a homeowner. And what we find today is that millennials are not becoming homeowners at the same age as prior generations, in part because they're taking more time getting educated and they're therefore not getting married and having children. That's not to say that millennials will somehow be this generation that doesn't get married at the same rate as prior generations or doesn't have children at the same rate as prior generations. And in fact, the surveys even suggest when it comes to home ownership that they desire home ownership more than any other generation before them. And in fact, the simple question is, yeah, but not yet. Not yet. Because the other thing is, when I was 27, single, and unmarried, I wanted to move to the suburbs. No, I was chasing girls. Come on, guys. Right? Right? That's what we're doing at the time. Those lifestyle decisions aren't there. The question is, do you think that when you do get married and have children and have a little bit more income and get that stability, you make the decision to become a homeowner? What is the single most important locational decisioning factor for where you choose to live when that happens? Schools. Anyone want to name a major metropolitan area in the U.S. where the schools in the city are better than the schools outside? Boston has some good pieces going. Chicago as well has some good pieces going. But generally speaking, that's not the case. The other thing is, millennials love to live in these really small spaces, right? Well, when I was in school, I didn't have much stuff because I couldn't afford any stuff, right? I'll tell you what, when I started having children, I realized it takes a lot of stuff, right? And the idea of renting the car to go to the grocery store when you got to do it 3, 4, 5 times a week becomes less appealing, shall we say, right? So all of those factors and decisions, I believe at least, drive this idea that homeownership, the drive for homeownership will begin in a very strong way in the next few years as millennials simply age into those things, but they're doing it at a later time. And the good news is they're getting educated, I get this right? They're getting educated at a higher rate and pace than any generation before them. And as long as you finish college, you're going to get what? A better income, which should mean down the road a better ability to afford to be able to be a homeowner, right? Now here's the thing. The educational attainment rate for millennials will go up into the 30s and peak around 40%. And that will be the highest attainment rate in recent generations. That's still less than half. That means 60% of even millennials will not have a college degree. That might prove a problem as the economy continues to automate, right? That might prove a problem. Let's go here. How are we on time? Half an hour, okay. The other thing to look at is we have to be careful about how we measure the home ownership rate, because a lot of people talk about gaps, particularly ethnicity gaps. They say, oh, this particular ethnic group has a home ownership rate that's much, much lower than usually the reference is non-Hispanic whites, right? Let's be clear. The population in the United States is changing. By 2045, collectively, the minorities will be the majority. And household formation will come, in particular, from two ethnic groups, more so than any other. Do you know those two groups? Hispanics, what's the other one? Asian, right. Average age of a white person in the United States today? 43, right? So we're already well up that home ownership curve, right? Average age of a Hispanic person in the United States today? 25. 25. Much younger, much more likely to be renting, in college, things like that today. But we have to focus on where all this growth comes from, Hispanics and Asians. Okay, let's go actually here. So we have to take this into account. The whites in the United States should have a much higher home ownership rate than any other ethnicity, simply because of the fact that they're significantly older. And if you're older, you're more likely to be married, you're more likely to have children, you get the storyline, right? And we find that the home ownership rate is almost 80% amongst whites. But we can't just simply say, oh, well, the difference between that and the home ownership rates for, say, Hispanics is 20% off because Hispanics are much younger. So we do this ceteris paribus, or controlling for all things, and say, let's understand for the same white person versus Hispanic person versus black person versus Asian person, controlling for age, whether or not you're married and have kids, what your income is, what your college level of attainment is. Take all of those things out and control for those. Now what's the real difference? And we can still see an 11% gap between whites and Asians, and an additional 9% for blacks and Hispanics. So there we see that there is a particular issue. Why is it that all else held equal, you see significantly lower home ownership rates amongst these groups, even though theoretically they're in the same lifestyle positions, they have the same income and capability, right? Do I have that slide? Let me go back and see if I can find it. Yes. Okay. Here's how you look at it by age, and you can see those differences in those gaps, right? But one thing that is really striking to me is at the age of 25, what the home ownership rate amongst whites are. It's already a good 10 to 15 points higher than any other ethnicity. At the age of 25. How does a 25-year-old person do that? 25-year-old white person do that? Any ideas? Parents. Because the odds are that their parents, sitting up there at over 80% home ownership rate at 55 and 65, will help their children with what? We call it intergenerational wealth transfer. Down payment. Right, down payment. That white young 25-year-old is much more likely to have access to than any of the other ethnicities. And that's because what is one of the things that we know about being a homeowner in the United States? It's one of the best drivers of what? Wealth. Wealth. And that actually simply comes from the fact that it's leveraged wealth, right? It's one place in the world where the average Joe consumer can actually leverage himself at a higher level than even Wall Street could wish for, right? You put 5% down on a $100,000 home, you're $5,000 in, it goes up by 5%, you've doubled your money. Now, what people neglect to sort of focus on and tell you is if it goes down by 5%, you've lost all of your money, right? But generally speaking, that never happens, right? Right. Okay. Where am I? I'm lost now. Hold on. Okay. So here's where we look at that future of home ownership demand, largely coming from the ethnic groups, basically those green line bars, adding to the home ownership rate over time. And the biggest thing here is that, say you take the Hispanic community, which will have the largest amount of household formation, the 25-year-old Hispanic today is not going to look, when he's 55 or 60, like his current 55 or 60-year-old parents are today, right? They are going to be much more likely to be English as a first language, much more likely to be college educated, have a higher level of income earning capacity, and all those good things. So even then, and we can't model this or sort of forecast this in these are assuming that effectively you do look like your 55 and 65-year-old parents. This is basically a lower bound. It should look even better than that in terms of household demand coming over the next few years. And we already begin to see it. I'll show you in a minute. We already begin to see it in the housing market with first-time home buyer shares and the amount of purchase activity that's coming from people under the age of 35. So it's already beginning, which is very, very good news. Okay. I'm an economist, so I'm supposed to forecast things. So here's my forecast. It's going to be sunny with a few cloudy periods today and Thursday, which will be followed by Friday. Okay, a few people got my economics joke. Good, good. I'm terrible at forecasting. I called the housing bottom 3 times. Only got it right once, right? We're really bad at economic forecasting, and there's a lot of good reasons why. Potential sales is green line. This is what we measure, kind of like that natural rate of unemployment we were talking about earlier. What is the amount of sales activity that should be happening in terms of existing home sales in the United States as a function of the size of the population, the number of households out there, what the interest rates are, what prices are, whether or not you're in an economic recession, things like that. Sort of what is fundamentally supportable by the market fundamentals. Blue line is actual. So you can see we got a little bit ahead of ourselves in the heyday, right? There was a lot of speculative behavior in home sales. People were buying and selling simply because it seemed like a good thing to do. We were treating housing much more like a financial instrument than the place that gives you shelter, right? There was a big correction. The zigzag in the blue line right after the session is the first-time home buyer tax credit, which really wasn't just for first-time home buyers, but it pulled demand back and forth as it came and went a couple times over. You can see most recently today, we are now underperforming potential. What are some of the reasons why we don't have more home sales today in the United States? Lackness of what? Supply. Lack of supply. Access to credit. And when I say these things, I'm not necessarily agreeing. I'm just sort of making the list right now. What else? Access to credit?
Consumer confidence.
Consumer confidence, yeah, maybe not sure about it. That comes and goes. There's another A word. Affordability, right? Let's start to talk about these things. So affordability, access to credit, lack of supply. Did I get this right? Oops. Lack of supply. Housing starts, single and multifamily. You can see that we've actually done a pretty good job in Blue Line in getting housing starts for multifamily back up to trend or a little bit above trend in recent years. But what we haven't done is generated a lot more single-family housing starts, right? In fact, it was one of the segments that collapsed so dramatically. See that orange line go down from a little over a million or 1.8 million a year to barely anything. And one of the challenges that we're finding today is we dismantled the supply infrastructure for building homes, right? You have to move lumber, usually from the Northwest to Atlanta, where a lot of homes were being built at the time, or Florida. We have to find construction workers who all left, right? And so the challenge now is actually rebuilding that supply infrastructure. All the rail cars that used to move lumber have been repurposed by the railroad companies during the 11, 12, 13 era to do things like move oil or natural gas or supplies to the oil fields in Idaho, because that was the booming industry, right? Construction workers went home, went to work in those oil fields and haven't necessarily come back. And now you have even more ironic, I don't know that this shows up in the major stats, but in Colorado, apparently builders are having a very difficult time finding drivers with CDL licenses, commercial driver's licenses, because they're all failing the drug tests. For one particular reason, right? So you can't get anybody to drive stuff. So that's the big challenge. And then there are also challenges with access to land supply, restrictions, and zoning, right? The big challenge also is even if I could build a home, Now the question is, what kind of home am I economically incented to build? A little one or a big one? A big one. The economics only work for me to make a profit by building a bigger home. So they maximize the amount of house on the lot, which generates a high-priced home, which is exactly what that first-time millennial home buyer needs, right? Right. Okay. Let's keep in mind here that we have had a 30-year tailwind behind us in the housing market, right? Long-term mortgage rate in blue coming down. Yes, period to period it would go up, but you can see the long-run trend right there, right? And if my mortgage rate goes down, what am I incented to do as an existing homeowner? After all, 63 to 65% of us are existing homeowners. Refi or move up, right? Refinance or move up, because the economic incentive is there. The money's cheaper. I can buy the same amount of housing for less monthly cost. So I'll buy a little more housing for the same monthly cost, right? I'll give you a forecast. I think mortgage rates are probably going to start going up. What happens to the incentive for that existing homeowner when rates go up? Am I going to refi? I already got a 3.5% mortgage, so we're all done there, right? That's done and over. Do I want to move? Maybe, but if I'm sitting on a 3.5% mortgage and now mortgage rates are, say, in 5 years, 5.5%, 6%, then the cost, and maybe I've got more equity, but equity just is a wash when you're an existing homeowner because you're just going to move it from one house to the other, right? It would cost me more to buy or to pay on a monthly basis to buy my same house. Not going to move. What might I do instead? Upgrade. HELOCs. HELOCs is going to be a huge and booming business going forward because about 2/3 of U.S. households today are going to be effectively locked into their existing homes with a nice 3.5% mortgage with a lot less incentive to do anything like move or refinance going forward. And that creates a big inventory supply problem, not just on the new homes being built, but the fact of the matter is most of the time a first-time home buyer buys what? New or existing? Existing. But all those existing homeowners who in years past, for the last 30 years, were always willing to supply that home to that first-time home buyer because they're busy moving up, may or may not necessarily want to do that. That might be a big issue. I call it rate lock-in effect. One other quick thing on this chart. Orange line is the effective federal funds rate managed by the Fed, right? Now, it looks to me, if I were back in the 70s, that there's some correlation, reasonable correlation between mortgage rates and federal fund rates. But if I fast forward to today, I'm not quite so sure about that, right? It doesn't seem like there's a lot of connection between what the 30-year fixed rate mortgage does relative to the funds rate that the Fed is going to pull. And I do believe they'll probably raise rates in December. Even with the current election results, there's still probably very good odds that that's going to happen. The point I'm trying to make here is I don't know that that really matters to us in the world of mortgage finance, right? Because the effective federal funds rate last December went up and mortgage rates went down. And this summer, what event drove mortgage rates down even further? What event drove mortgage rates down even further? Brexit. Yeah, rates went down. Why? Because we were the prettiest horse in the glue factory in the world economy, right? And when everyone got scared about what Brexit meant, they all flee to what? 10-year and 30-year treasuries, which is really what drives the overall long-run mortgage rate, right? And they went down. Yields went down. Interestingly, after the election on Tuesday, 10-year yields have been floating around 1.33 to 1.5 maybe percent for the last 6 months or so, and they popped up by like 40-some basis points above 2 in just the last couple of days, right? Which means probably we will see in the next week, or probably come out this week or next week, we'll see a significant increase in the mortgage rate because 10-year yields actually did jump last week. And that might be the beginning of actually what drives, I say it's Trump trumped Yellen. Get it? Trump trumped Yellen. Yeah. In terms of our impact on mortgage rates in the US today. All right, let's talk prices and then we'll be finished. Green line is the nominal house price level, unadjusted, indexed to January 2000 at 100. So you can see at the housing peak, we were 80% above 2000 levels in terms of prices. The correction knocked off about 40% nationally. Of course, it's much more interesting when you look at the map. I'll show you that next. And has now gotten back to prior peak levels in prices, right? Housing is so unaffordable. And it's true that housing has significantly outpaced the appreciation rate, 5 to 6%, has significantly outpaced income growth, right? We already talked about all of that. But does that really what matters? Is it that the house is worth $1 million today that was maybe 600 or 800 yesterday or a year or 2 years ago in San Francisco? Or is it how much does it cost for me to be able to afford to live there on a monthly basis in my mortgage payment? Do I really care about the level as much as how much I'm paying per month, right? The consumer is interested in how much they can afford to buy as a function of their monthly payment. And that's driven by incomes, right? Growing income, I can buy more. And at the moment, more importantly, rates, right? So when you account, blue line is basically the house price appreciation growth rate in purchasing power held constant terms. In other words, accounting for the amount of increased purchasing power that consumers have today, which is phenomenal compared to years past. With a 3.5% 30-year fixed rate mortgage, given your income, you can still buy an awful lot of house, right? And so prices are actually in large part responding to that. One of the reasons they're going up by 5 or 6% much faster than incomes is because rates are coming down and driving that leverage, right? Allowing us to be able to afford to buy. So purchasing power adjusted basis, housing today is 20% more affordable than it was in 2000, and 40% more affordable than it was at the peak. In fact, housing is as inexpensive as it's ever been in the last quarter century. You guys believe me, or you're like, what the hell is he talking about? Just do the math. Purchasing power adjusted basis, the fact is, because interest rates are so low, that you don't need that much income to be able to afford to buy that home. Let's do a simple example. Average salary of a new entrant into Silicon Valley, got his computer degree, goes to work at Google. How much do you think he's making? 75, right? He gets together with a buddy, girlfriend, maybe he's married. They've also got the same degree. Household income is now 150. The old adage of 3 times your income to be borrowed, that would be under mortgage rates of 7, 8%. Now you could roughly make the math easily work at 4. So 150 times 4, that's $600,000 you could afford to borrow, right? Add $100,000 from mom and dad, now we're talking about a $700,000 home. That's actually reasonably affordable, and there are a fair number of those homes in the Silicon Valley Bay Area like that. And that's what's driving demand, right? Rates go up, and we'll cut that demand back a little bit because that 75 doubled to 150 household income won't be able to buy that much, but then also house prices will slow down. Oh, and by the way, if rates are going up, that's probably because the economy's doing kind of well too, so we might get more income growth. Here's how you look at real house prices across the United States. You can see anything in blue is basically under 2000 levels, and anything in green is above. So yeah, there are more expensive markets, particularly in New York and California. Most of the markets in California are modestly more expensive today than they were in 2000, but it's a far cry from the peak levels of house prices, leverage induced. All right. Let's do this one last one and we'll stop the questions. So when you look across the problem with, is the housing market healthy or not? Is it normal again? That's all about your perspective. If you're a real estate agent, it's how many homes are you selling, right? If you're managing a portfolio of risk, it might have to do with foreclosures and REOs. Depending on your perspective, what's healthy or not can be very different. And so we're basically doing another one of those same kinds of spiders relative to the baseline peak of 2006 across home ownership progress, nominal house prices, real house prices, existing home sales, new home sales, that potential home sales level, and then the 2 levels of distress. And you can see, under most scenarios, currently in 2016, that green, we're doing quite well or sort of normally based in most metrics except for new home sales. That's the one area where we're definitely still behind. So, and with that, we'll go, oops. And any questions? Do we have time for questions? Yeah, good. Yes? Do my slides support Trump or Clinton? If my slides could talk. Look, so we do a survey of our title agent base. I work for First American. Title is our business, right? We survey our title agents, and I asked the question in our most recent survey, which was the last 2 weeks just before Election Day. I said, of all the candidates, you tell me for each candidate whether you think they'll be good or bad for housing. And overwhelmingly, the response was that Trump would be better for housing than any other candidate, right? And that really comes from this idea, certainly in the mortgage finance, traditional mortgage framework, we're all really feeling burdened down by regulation. We really struggle with some of the aspects of Dodd-Frank. That's not to necessarily say that Dodd-Frank is bad, but the fact that the CFPB can sue you, or the Treasury Department, or the Justice Department can sue you because you forgot to cross a T on a loan application, and they can sue you under the False Claims Act for triple damages, right? When that loan hasn't even caused any damage yet, right? You know the False Claims Act, right? It came into being at the time of the Civil War because people were selling shoddy horses to the Union Army. That is not the same thing as a loan document missing a cross T. Yet that's what's going on. So that response to that has been pretty strong in the industry. And I think the pro-business, anti-regulation perspective that I think Trump represented more so than any other candidate clearly would say that it's indicative. And what has been coming out of as he's forming his administration seems to indicate that the mortgage and housing finance industry will get some regulatory relief. And that's probably good for the mortgage industry. Whether that's good or not for consumers, let's just take another question. Any more questions? Yes, over here, sir.
Unemployment at 5%. Just look at your chart. Go back, I don't know, 20 years, whatever. It was at 5% previously another time.
Mm-hmm.
Has the definition of unemployment and the way has your chart taken into account the change in the definition of unemployment, or has the definition of unemployment the way it is right now isn't the same? I guess is really the question. Is that somewhat misleading?
I mean, I think technically the way the government does its accounting hasn't changed over time. It might not be the most appropriate measure of labor market health, but the number and how it's calculated hasn't changed significantly over time. What they have done is added new ones like the marginally attached and part-time unemployed to get a better understanding of the labor market. I think what's more interesting is the JOLTS data. Have you heard of JOLTS? Job layoffs, turnover. It basically is how many people are quitting their jobs, how many jobs are being opened, how many jobs are being taken. So that flow dynamic is, in my mind, a better representation of what's going on in the labor market. Unemployment is a nice headline number, but far to, I think, your point, oversimplifies the problem. One of the things that we're noting actually is that natural rate of unemployment. We see the unemployment rate go below 5% and inflation doesn't go up, which seems to mean that either that's not really measuring it properly or we don't know how to measure natural unemployment properly, right? And so the labor markets are changing and more volatile and more dynamic today than they were, say, 40 or 50 years ago. Yes?
You were talking about productivity, and a lot of people believe millennials are not as productive as a class. As they get older, do you think productivity is going to get better? That millennials are going to be able to...
Sorry, what? Sorry? What? Yes. Yeah. Go ahead. I was listening. Go ahead.
Basically, you're talking about productivity being waning and not being so strong.
Yeah.
And that we have more technology and we're less productive. Millennials are not as productive.
So I don't know that there's no data I think to back that point that millennials are necessarily less productive. You could make the argument that there are many more distractions in our daily work life that collectively make us less productive at work. But by the same token, how did you used to get information before Google?
Well, what do you use to drive productivity is really more my issue.
Yes. The question is, and this is a big thing that very important economists, much more versed in this stuff than I, are actually really struggling with, is, geez, productivity's falling off the map. How do we make productivity higher? I'm not quite sure what really drives productivity in the first place. It's really hard for us to technological change. Well, shit, man. We've had a ton of technological change in the last 20 years. Why don't we see more productivity, right? Right? Maybe it's because Twitter and Uber and all those things aren't particularly productive. You want to jump in and say something?
No, I just want to ask you.
Oh, okay. Okay. So the challenge is we really aren't quite sure, although in the studies we're beginning to find there are certain things that hinder productivity. To get good productivity, you need innovation, and to get good innovation, you generally need less regulation, right? And so while that is being debated, and I don't want to get into the politics of that, that is something that we're looking at as economists and saying, you know, the regulatory environment may in fact be hindering innovation, and that might be why we're not seeing as much productivity growth today. Yes, and then here.
You know, I thought great data points on the charts. One thing it did tell me, what do you predict is going to happen to housing prices, getting rid of, you know, any government interference one way or the other, based on your data? If someone was holding a gun to your head, what would you say over the next 5 years? Get rid of government interference. But
So-
it's unpredictable. What's going to happen?
So when we forecast out rate paths, and right now we're forecasting, well, we're revising our rate path up given last week's movement in the 10-year yield. We're forecasting a rate path into the end of 2017 that looks like a 4.5% mortgage by the end of 2017, which is still highly affordable, right? And under that scenario, house price appreciation slows down to barely a 4.1, 3.9 kind of pace, because you cut a little bit of demand on the margin, right? Home sales cut down by about 150,000 relative to if rates sort of had gone a lower path, unshocked, at about a 4.25 by the end of 2017. So I expect house price appreciation should cool as rates go up, and we should get an all else held equal slowdown of about 140,000 existing homes. That's compared to 5.5 million. So it's a very, very small impact on the for sale side, more impactful in the slowing of house price appreciation. What that doesn't account for is that force of demand may in fact still push the overall amount of existing home sales higher. But rising rates has that modest impact, mostly felt in prices, which I think is actually a good thing. Because in the long run, we can't clip along at 5 to 6% in nominal house price growth nationally without income growth. That is not in the long run sustainable. So I want home prices to cool.
What about in the overheated markets like California and New York?
Well, to my real house price point, they're not really overheated. They're just responding to this insurgence of high income earning individuals with huge amounts of leverage. That's what's bidding up prices in those markets, right? And the existing homeowner in that market is not hurt because he already owns the asset and he's now more wealthy. It's the marginal income renter, can I paraphrase, the barista who's lived in San Francisco all his life, who's being priced out by the new entrant computer programmer who's outbidding him for housing, right? That's what's happening in those markets. So it all depends on where you sit. If you're the highly educated new entrant, not a problem. If you're the existing homeowner in San Francisco or New York, not a problem. If you're renting and you don't have a lot of skills to apply to this labor market today, huge problem. And that's roughly a quarter of the population in the US. Yes? We keep going on questions? Just cut me off when we're ready.
3 more minutes.
Okay.
So your data suggested that although latent millennial home buying behavior would be very similar to what we see in other generations.
Yes.
From your perspective, how do lenders take advantage of that as it pertains to that market of millennials?
Right, so there are really 2 simple issues to address. One is that millennial home buyer is not going to look like home buyers of the past, right? They're going to be a much more ethnically diverse population. They will also be more educated, right? And then, so you have to consider sort of in these different cultures, there's different perceptions of lending, different perceptions of where you put your money. I mean, Hispanic culture generally doesn't believe as much in the banking system. There's intergenerational income coming into these more complicated households. Those are the kinds of things when it comes to looking at the ethnic diversity. How do you create mortgage products that are that fit those sort of communities? And then probably the biggest one is how they consume information and how they want to interact with you, technology. Now, I'm not saying that somehow we're supposed to be able to get a mortgage like you get a car on Uber. It ain't that simple, right? But what I am saying is, And you guys know it best. The traditional mortgage industry sure does make it complicated, right? And so how do we create technology, create loan products, fix the processes of lending to be more amenable to that technologically cell phone, information-driven individuals? They do a lot more shopping than any prior generation did, in large part because it's so easy to do that shopping. Yes, yes.
I did have to step up, take a phone call.
Now, you missed all the good parts then.
I did. One of the things that I was looking for was how are we going to deal with this ever-increasing debt? And I'm talking more when we look at the way our productivity and the economy has been, we have basically leveraged it.
Mm-hmm.
And as lenders in this room know that if somebody cannot pay, there are only three things you can do. You can stretch out the payment, you can change the interest rate, or you can modify the loan cut. Either way, you're looking at the value of the asset.
Right.
So you're talking about, increasing economies, and we're looking at a way to fix it that is deflationary by nature.
So, when it comes to the federal debt, there is one other tool that you don't have and the rest of us don't have, and that's that we can print money, right? And we can inflate away the debt. So it's not the actual sheer size of the amount of dollars that matters, it's the relative size to GDP, right? Because if we can grow our economy and inflate it away, it's $1 million of debt today, 100 years from now, it's not going to seem like that big of a deal. We can do two things. One is stop adding to it. That might be a good start, right? And because we are going to have to take more of our returns or revenue from income taxes and things like that to pay for servicing it. But the probable solution is you don't try and pay. This is not something that ever gets paid back. It gets ultimately inflated away. And we've had two other prior times in American history where the debt to GDP ratio has been even significantly much higher than it is today. Name those two times. World War II and one other, Civil War, right? So, and we basically you sat on it. Now, the difference between those two times and now is that we actually went through periods after the Civil War. We went through a significant period of time where we were running deficit surpluses to help pay it down.
I'm not worried about the federal debt because, as we see that the Federal Reserve can take it out of the economy and let it disappear.
Mm-hmm.
Okay.
So what debt are you referring to? Consumer debt?
Yeah, I'm talking about the millennials who are graduated with a mortgage payment and no house.
Yeah, so go look up my article on Inman News, I actually just published today, that talks about student loan debt. And we can take this conversation offline. You can't focus on the amount. You have to focus on the servicing cost, right? And because we don't ask in the world of underwriting, we don't ask, how expensive is the Maserati that you own in the parking in your garage? It's how much does it cost per month to pay for it? And that has remained consistently stable as a debt to payment to income ratio at about 4% of income. Even though the debt amounts are much higher, it's still only 4% of your income. That's not that much, and it's been like that for the last 25 years. I think I'm being hooked, so thank you very much for your time.